Welcome to Operation Successful Transition. In this podcast, my guests and I will be talking about the 4 pillars of housing, work, benefits, and mental health to open doors for veterans and connect you with the people you need to meet. We deeply appreciate your service and sacrifice and hope to help make your transition back to civilian life smoother. Your success is important. You are important. Hello, everybody. This is Sherri Echols, your host. Welcome back to another episode of Operation Successful Transition. We are here today with Milynda Hallerman. She is a mortgage broker, right, with SWBC Mortgages. And today we're going to be talking about credit repair. So we're going to talk about like what makes up credit, kind of a quick fix on credit if you're looking to buy a house quickly, or the longer term if you just want to have good credit for a whole bunch of different purposes. So let's get started with the top of your list here today then.
Well, howdy, Sherri. Thank you for having me. Like Sherri said, I'm Milynda.
Yeah, welcome back.
With SWBC Mortgage, and VA loans are my specialty, but I can do the entire suite of any kind of mortgage product, basically. And for any mortgage, credit score is going to be a major factor. Number one, what type of mortgage you might have access to, as well as what your rates are going to be. So it's not just mortgages. You will find once you get into credit that it's going to affect the interest rate that you get on a car loan, on any kind of equipment loan, anything. Your credit score is going to play into how much deposit you might need, or if you even need a deposit when you go to get cell phones, things like that.
Your insurance rate is dependent on it as well.
Insurance rates too. And the number one thing that a credit score is, that is a lender trying to squeeze all the information they can about you into one number. And so that's never going to tell the whole story, but it's the best that we've got at this point to give that lender an estimate, a good guess about whether you're going to pay your loan back on time, because that's what they want to know. They want to know you're going to pay your bills on time, and that credit score is their best shot at representing that. So what goes into a credit score? Actually, let's back up. Let's talk about who does credit scores. There's 3 credit bureaus that each have their own special secret formula, and it really is a secret proprietary formula for how they are going to score your loans. And that is Experian, Equifax, and TransUnion. And you can enter the same exact information into those 3 bureaus, and you will get 3 different scores because their algorithms are a little different. So any lender, any mortgage lender is going to pull all 3 bureaus, and we're going to use the middle score, hoping that that's the fairest score for you. Those scores, when you read about it, they range anywhere from, they'll say 350 to 850 as far as the numbers. In practice, I've only seen scores go down to about 450 and up into the 820s. So I would say most of your scores are going to fall in the, let's say, 550 to 800 range would be a good thing. 620 is kind of a magic number for it being much easier to get a loan. Lenders can do loans under 620, but if we could get your score up over 620, that would be better for you as far as your rate.
Right. And here's a reminder that for VA loans, you can have whatever credit score.
Yeah.
It depends on the lender. Yeah.
There is, VA doesn't put a bottom score for a VA loan. Some lenders will put bottom scores, and some it will be 620. I can do down to 580. It gets easier at 600, to be honest. 580 is probably the lowest number you're ever going to hear, but technically there's no bottom limit. So.
Yeah, but if things are that low and that bad, you probably don't really need to get into a house and a big payment. That would just be a disaster.
Probably want to get your finances in just get those sorted out before you add a huge commitment of a mortgage to your finances, for sure. So if you're thinking about buying a house, and this translates to anything else in your life, car, student loans, anything, insurance, like Sherri said, you want to start looking at what is on your credit report and what your scores are as early as you can, really, because 30% of credit reports have incorrect information on them. One way to look at this is, yes, it's an automated system, but all of that information has to get imported into that system by humans. And humans make mistakes, and there are going to be human errors on credit reports.
There's also a lot of scams and identity theft and all that too. So when you pull up your credit report, you may have some surprise on there, something that totally doesn't even belong to you that you need to fix. So even a year before you want to look at buying a house, it may take that long to get things corrected, or if you do have things that need to be paid down, and that it may take a little while. So Milynda's right that it may take a while.
So it's never too early, really. And getting your credit pulled, it does need to be a hard pull. We'll talk about soft pull versus hard pull. For it to be any good at all, it needs to be a hard pull. People get scared, like you will read on financial websites, oh, pulling your credit can lower your credit score. That is such a small amount that it might ding your credit score. In my opinion, it is worth the trade-off to see what's actually on your credit, because until you actually do a hard, you don't know.
We've lost you.
I think I just declined. Hold on, I'm coming back.
There you are.
Hey, there I am. Okay, so you do need a credit pull. It is not bad for your credit. Now, that's going to be a mortgage lender doing one pull. Now, that's not quite the same scenario as going to a car dealership where they're going to get your authorization and then they're going to pull with 15 different lenders without telling you. That could hurt your credit, but that is not going to be the situation with a mortgage lender. I'm going to pull once. I'm going to pull all 3 scores, so I have the scores and the whole credit report. That way, if the scores are a little low, we can look at why they're low. We'll look at the credit report. There's some different reasons why they might be low. If they're not low, and we're just looking at what existing credit you have, then we can start on figuring out, okay, well, if we've got this much debt every month already, how much of a house payment can we add to that and still have you comfortably living within your means? That's how we then figure out house price, which is going to tell us what house price you're going to be shopping for based on that payment that's going to work for you.
Right. And there's a ratio of debt to earnings, right, that you want to stay within. So what is that number when we're calculating?
Yep, that's the biggie for debt to income, called DTI. So DTI and your credit score or your FICO score are 2 of the main things that we're looking at. So what's included in your DTI? It's actually not everything that you might think. Your utilities, your groceries, your monthly expenses, those aren't necessarily included in DTI. Things, anything that shows up on your credit report. So credit cards, car notes, notes for anything else, like if you have an RV or jet skis, any type of installment loan like that will be on there.
Student loans.
Student loans, even if they're deferred, they will show up on your credit report. So any kind of monthly payment that you have that you sign for like that, but not including cell phones, utilities, rent, none of that is going to be included in that. So we're going to take that baseline, whatever that is, and then we're going to add to it the mortgage payment that we're proposing, the homeowner's insurance, and the property taxes. One thing that's special about VA loans is VA is also going to calculate in any child care expenses you have. So if you pay daycare, we're going to include that. And they're also going to look at something called residual income, which is really VA looking out for the veteran to make sure that after all your bills are paid, you have enough money to live on the rest of the month for things like groceries and utilities.
Yeah, don't want to be house poor.
Yes, they really don't want the veteran to be house poor, and a lot of this process is designed to avoid that. So that's where we get our DTI. We ideally, in a perfect world, the total debt every month would be no more than 45% of your income, and that income. Okay, and income's another tricky word. We have certain things that fall into debt, and then we only have certain things that fall into income, and those are going to be your pre-tax earnings, okay, so your gross wages, not the amount that shows up in your bank account, but the amount that the gross on your pay stub, we're going to count that. If you have any type of service-connected rating and you get a disability check, we're going to count that. Child support, if that falls in within the realm and you want to count that and you're receiving child support instead of paying it, that kind of thing. So there's several different components of income. Once we get those calculated, we want the debt to be no more than 45% of the income. That would be ideal. We can go over sometimes, that's a case-by-case basis, but 45 would be a nice general number to use.
Good. Well, that's something to shoot for sure.
For sure. Okay, so let's talk about what goes into a credit score, because that's going to tell us how we might improve and what we might need repair on. The biggest part of your credit score, of the 100%, 35% of that is your payment history. And that goes back to that score. All of this is all about them being able to gauge whether you pay your bills on time. So 35% is credit payment history. 30% is the amount that you owe. And that they measure by how much you have, so much limit. Okay, so let's say you have a card with $1,000 limit. Well, do you keep it pretty much maxed out all the time, or do you charge a little bit every month and then pay it off? Because that's the same credit amount, but that's two really different ways to use it. So they're going to reward you for not keeping your card, not keeping high balances on your card.
So I've heard that if you have, that it's best to keep it like 30% or less of the limit. So if you have 3 cards of $1,000 each, don't put 900 on one, have 300 on each. That is looked at better than having one totally full and the other's totally empty then.
Absolutely. Yep. Because they're going to look at it trade line by trade line, which means, credit account by credit account, and they don't want to see any of the credit accounts maxed out. So Sherri's right. If you need to charge up 900 and pay it off over time, spread that out among your cards. If you can keep them at under 30% of the available balance, that's ideal. Life happens and sometimes you can't do that, but if you can, that would be a good way to keep it, to maximize how much of your credit score you can get boosted for that. So there's some more. There's a few more components of credit score. One of them is age of your credit accounts, or length of your history. That's 15%. So that really is kind of a function of age. So younger people, even if you've got great credit and you're really young, but you've been paying your bills on time, you're not going to get to realize the full value of length of credit history because you're not old enough. But
here's the thing. Parents can put their kid on their credit card as a signer, and that can start building your child's credit score. Yeah.
Yeah.
I've lost the thought on the other one. Keep going.
So that's one thing you can do. And if you have let's say kids that are going into college, like my daughter is starting at A&M, college students do get offers for credit cards with no credit history that aren't secured. So that's a really good thing to do for if you have college students in your life or you're trying to help them establish history, go ahead and do those cards. I know that, 30 years later, I still have those credit cards that I got when I started college.
So here's another thing. You don't want to close out accounts, right? You don't want to.
That is an important part of the length of the credit history. And people want to do that. People will pull their credit report, we'll talk about what's on it, and they'll say, oh, well, here's I don't know, a Pottery Barn credit card. I haven't used that in 10 years. and it's still open. I'm going to cancel that. To which I say, no. Do not cancel old accounts, even if you don't use them, because they are sitting there helping your credit and adding points to your credit score. Because what it shows the lender the lender is that you have that credit card, but you have enough financial sense and financial responsibility to not go charge it up. And they're going to reward you for that with a higher credit score. So never, ever cancel old accounts because you're not using them. Just let them sit there. They're actually helping you. So that's going to be 15% of your score. 10% is new credit. Really, this is not something you don't ever want to go get a card unless you're really going to use it. Don't go get a store card to get 20% off of that day's purchase. That is never worth doing. If you are wanting to build credit history and you love Kohl's and you shop at Kohl's and that's the only place you get your clothes, then that may make sense to get a Kohl's credit card or a Lowe's credit card if you do home improvement. So I'm not saying don't get specialty cards, but do them for the right reason, because you know that you're going to go to that store and then they give you a good value, like that maybe they give you, I know our Academy credit card, we get 5% off our purchases, and we're in Academy a lot. Made sense to get an Academy card. So do it for that reason, because it does also, that segues right into another, that last 10% of your card is what they call credit mix. And that's going to be that you have different types of loans. So you might have credit cards, you might have department store cards, which can be coded differently from a Visa or a MasterCard. Mortgage is one, car loan is one, a different type of installment loan, which might be just any type of personal loan or an RV loan, that type of thing. So having a mix of different types of credit, showing that you're able to use different types of credit, they're going to give you points for that as well. But the main things are pay all your bills on time and don't max your cards out. That's 65% of your credit score right there.
Yeah. How does like sometimes people get big medical expenses that they pay down? How do big medical expenses count into the credit mix?
Well, and I think that you can get what's called a care card now, and you can, that goes on your credit, those healthcare credit cards, and you're going to pay that down like a regular debt. You're going to pay it down like any other credit account. Medical chart, where we really see the medical stuff come into play, is charge-off. Lots of people have medical collections on their credit, and sometimes they don't even know it. Because when you go in the hospital, you don't just get a bill from the hospital. Depending on what happened, you are also getting a bill from a radiologist and a pathologist and an anesthesia. So there's all these bills that come to people, and sometimes you don't receive them. Sometimes they're addressed wrong. Sometimes you receive them and they just get lost in life. And sometimes they don't get paid through, and not that you're not trying to pay your bills, but stuff just slips through the cracks, particularly in medical situations, it seems like.
Yeah.
So some of those, you wind up going to collections and you didn't even know you had a bill. Those collections will also get sold, right? Because those creditors can sell their debt to debt collectors, and that's when you might start to get phone calls. If you do start to get phone calls, or you see when you're talking with your lender and you see that you have some medical collections on there, never pay those off without talking to your lender or your credit advisor first. Let them guide you, because they're going to be correct actions. They may differ depending on your situation, what you should do and what you should not do. Do not go run and try to pay those things off. That might actually be the exact thing you shouldn't do for credit score purposes. So that is definitely, let the professional help you. That's my job, to give you feedback and guide you on the best way to handle those in terms of getting your mortgage.
That's important to know, because I think the natural tendency is, like you said, to cancel out old accounts, clean it up, pay the little things off and have it all nice and neat. But that's not always the best course of action. So definitely important to talk to your lender first. And you've got to find a lender who has some experience and who knows stuff from Shinola on this. You don't want someone to guide you correctly and end up worse off than you started out. So be sure that you get a lender like Milynda, who has lots of experience and knows what's going on.
And one thing, since we're on the subject of collections, judgments are different, okay? And judgments are also going to show up on your credit report. So what's the difference? A judgment means that somebody actually took that debt, and it could be anything from medical bills to, it could be If you broke a lease at an apartment and that apartment complex thinks that you still owe them money and you don't pay it, they could sue you. So a judgment means you got sued for whatever it was. You got sued in a court and they found against you. You lost, basically. So you have what's called a judgment against you. That's not necessarily on your credit report, but it's part of what we pull with the whole credit report process. We pull a report on liens and judgments. And so if you have a judgment, that's different than a collection. You may have a collection on your credit that we don't need to pay off. We don't need to touch it. Okay, it depends on your loan situation. But a judgment is a court ruling that you owe somebody money. And if that happens, you are going to have to pay that judgment before you can buy a home. And sometimes people don't know that those are on there either. A lien, which could also, that's another thing where if that shows up on your report, you're going to have to pay that off before you can buy a new house. So what's a lien? Well, a lien is going to be kind of a judgment that's held against an asset, and that's usually going to be a house. So let's say that you owned a house before. You had a repairman come in, and let's say you got a new roof put on, but you never paid the roofer. The roofer tried to collect their money. They didn't get it. So they put what's called a lien, a mechanic's lien on your house. So they, if you ever go to sell that house and they do the title search on it, that lien is going to pop up. And in order to sell your house, you're going to have to pay that lien off. So that's the same kind of thing. Judgments and liens, you have to resolve before you can buy a home. Collections, we need to look at that on a case-by-case basis. So, okay, so what next? All right, so let's talk about, I pull your credit. Let's say that I see we've got scores of 600 and we sure would like to get it over 620, because if we could get it over 620, we could get you a better rate.
Yeah.
I can do what's called pull wayfinder reports. They have different names depending on the service that the lender is using. But those are automatic reports I could pull that are really exact, and they will tell me things like, okay, right now we're at a 600 credit score. To get to a 620 credit score, we need to take these very specific actions, and it will be things like pay down the balance on one credit card from $500 to $150. Might not even be that much. It may just be pay off this $50 balance on a credit card. I've even had it be things like if people had credit they hadn't used in forever, go make a purchase with your Walmart card. And so then you go pay make a $30 purchase with your Walmart card. That puts your Walmart card with all of its good credit history back up into your current payment cycle, and it boosts your score. So, but they're very specific things that can be done like within that next 30 days. So in a really short period of time, and we'll have a really good estimate on how many points of a bump you'll get with each action that you can take. And
so is it really that fast? If you do something within 30 days, they'll have it within another 30 days, or what's the kind of timeline on that?
If you're doing it with your lender to help, yeah, it can be within 10 days. I mean, it can be really fast, because what can happen is, let's say it's an action where the report says to pay $200 on a credit card and your score will go up 15 points. Well, you have that $200 and you want to make that payment. What you would do is you would pay the bill, go online and pay it right then. As soon as it posts to your credit account, you let me know. And we don't wait for the next billing cycle, because if we just kind of waited for the billing cycle, it would take 30 more days.
Right.
But we don't do that. You're going to get a letter, it's a little form letter from the bureau, from the credit account, that you paid that much, and it'll have your current balance on there. You send me that current balance letter. I send it into the credit reporting bureau and say, hey, here we go, balance is down. They will rescore your credit for you that fast. So it can be a 7 to 10 day, and
nice.
That's all. You do not pay for any of that.
Yeah, and so it could be as simple as one or two little things, not a big old hassle. So that's where it helps also to talk to a lender I mean, even a year out, I mean, they can just pull it for you and give you guidance on what you need to do to have it in good shape the following year if when you're ready to buy. So,
Yeah, yeah.
so
So those,
oh, go ahead. I'm sorry.
no, that's short term what we can do. Okay, so and that's great. We can get a lot done in the short term. Sometimes your credit situation is not a short term situation.
Right.
If you have been chronically late,
We lost you again.
hold on, we're coming back. We're coming back. Okay.
Here she is.
Okay. So sometimes it's not a short term fix. If you have had a lot of late payments, a lot of times the best cure for those is time. And I know that's not what people want to hear, but it's always going to be the most recent 12 months of your payment history that's going to make up the most of that, because that's 35% of your score, right? That credit history, the bulk of that is the last 12 months. And most of what's left is that previous 12 months. So a total of 24 months with an emphasis on the most recent 12 months. So if you've got more than one or two late payments for anything in that last 12 months, it's really going to affect your score. And it could be a $25 payment that you got that was late. I mean, it is not the amount of the payment that they care about. It is the fact that it was late. So a $25 payment that you skipped can hurt you as much as a $1,000 payment that you skipped. Okay. So seems counterintuitive, but that's how it works. So if you've got 6 late payments on things on your credit report within the past 12 months, we may need to let some of those age off. And that just means getting those late out of that 12-month window. And the solution for that is time. So every late payment you want to avoid at all costs. I mean, you know you have to pay that bill. If there's any way you can do it on time, that is just the number one way to help yourself. So that is a situation where we just have to wait some time. They want to see a clean track record, and they want to see those late payments in your past, that you are moving forward and you're paying
good habits.
Good habits, and they're going to reward that. You're going to see your score come up a little bit every single month that you make every payment on time.
Great.
So, yeah.
So, I was going to ask about, so what about the Dave Ramsey kind of people who only like to pay cash? How long is it going to take you to set up credit so that you can get a mortgage should you end up needing one?
It is. Dave Ramsey is great for a lot of things. He does not know what he's talking about for mortgage. Okay, he just doesn't. And hopefully part of what you're building is enough financial discipline that you do not have to do that. You don't have to go that route, because credit is a tool when it's used correctly. And you want to have credit for things like emergencies too. Mm-hmm. Hopefully you never need to charge, something big on a credit card, but if an emergency comes up, you definitely want it there. So this is about using financial responsibility and restraint. I recently had a couple that I was trying to help get a mortgage who lived that cash lifestyle. When I went to pull their credit, their names showed up, but there were literally no credit scores because they hadn't done anything on credit for at least the last 3 years. So the credit bureaus quit scoring them because they didn't have any data. Right. And so it's hard to get a mortgage lender to make you a 6-figure loan when you have no payment history for the last 3 years.
Yeah.
And that was very hard to explain to those customers that they thought they were doing a great thing and paying cash and not owing anybody money. But in this case, that didn't help, because a credit history is you demonstrating that you pay people back on time, and they didn't have that to show anyone. So what the bureaus say when you go look it up is if you're trying to build a credit score, you need at least 2 trade lines. So that could be 2 different credit cards. It could be a credit card and a gas card, or a credit card and a car loan, just 2 different things that report your payments for at least 3 months. So you need to get 2 different accounts and make 3 payments on them. And then that's what Experian, Equifax, TransUnion, that's what they say is enough to generate a credit score. for you.
So if you say you get a gas card, you don't go charge gas on it and then go home and pay it. You have to wait for the bill to cycle one time and then just pay it off each month.
Mm-hmm.
That way it gets recorded that you are making the payments. So you can't just go charge it and pay it. So that's important to put in there because.
Yes, you need to wait for that bill to come around and pay it, charge on it a little bit more, pay it, and do that for 3 full payment cycles. Because part of what they're wanting to see is that you have responsibility and restraint, and you will pay over time. So if you just pay it off instantly, you're not proving to them that you pay over time, and that's part of what they want to see.
Yeah.
So, and secure credit cards can work for this too. If you're trying to rebuild your credit or you're trying to build a credit score fast, you can get a secured credit card, which is where you basically open an account with their bank and you put in $200 or $300. Then they give you a credit card with a $200 or $300 limit. Those cards are designed for people to prove that they'll pay their credit cards on time. So that's also an option.
Yeah. So what are other credit score pitfalls that people need to watch out for? Like, I don't know, co-signing, or what are other common things that you see? Identity fraud, identity theft, or other fraud, those kinds of things?
I would say the main thing would be co-signing, which is definitely something. What you're doing when you're co-signing is you're not obligating yourself to part of that debt. You are obligating yourself to the entire debt. You do not get to pick and choose and say, well, I only meant to co-sign for half. It's the whole car you're co-signing for, or the whole house, that kind of thing. So you need to be very thoughtful when you agree to do that for a family member or a loved one. And you need to treat it as though it's your bill. Even if it's not your bill, it could be, if something happens and they're unable to pay. Now, another thing that we run into with that type of situation is, let's say that you are an authorized user. This happened to one of my clients recently. Her parents had put her on their credit cards when she was really young to build her credit. Well, 10 years later, she doesn't ever use those cards. She has her own credit, but she's still an authorized signer on her parents' cards. So when I went to pull her credit, it had her parents' credit account on her credit report, because authorized user, cosigner, whatever, it's on your credit report like it's your credit. And that was affecting her debt to income ratio because they had high balances on their cards.
Which could have been fine with their debt to income ratio, but not her debt to income ratio.
Now, it didn't hurt her score because they paid their bills. Her parents paid their bills on time. And we were able to prove through payment history that those really were their credit cards. They weren't hers, and that they paid all the bills. So then we got to exclude it from her DTI. But there were several steps along the way where that could have gone wrong, and we would have had to include it with her. So once you do that, just know that once you're an authorized signer, you can be removed. But once you're a co-signer, you're pretty much on there forever. There's no take backs, right? So just be very thoughtful when you do that, because it can have a ripple effect that you don't think about initially.
Yeah. And long term. Sure. Yeah. The other person would have to refinance or pay off in order to get your name off that loan. You can't just get off.
An authorized user, the person who owns the account, can get that authorized user removed. But once you co-sign, you can't get yourself removed as a co-signer. No.
Yeah.
Yeah.
So another important credit score thing that we need to mention is, once you're under contract, don't add any new credit card accounts. Don't buy any furniture, any appliances. Don't spend any big money. Just do your regular groceries and gas, whatever is regular for you, because you can change your credit score. And if it's pulled on closing day, which it normally is, yes, they pull it on closing day. If your score is out of whack on closing day, it ain't going to happen, right? So you get to the end, then you're in trouble with your seller, and they could take you to court and force performance, or you could be out your earnest money and all that.
So Yes. So once we start the process, and this is something I, advise on, once we start the loan process, we basically want you to stay the same. We don't want any changes. If there are any payments that need to be made to pay things down for credit scores, then we'll talk about that. But like Sherri said, during that time, all bills paid on time, every time. No new credit. No, do not go buy furniture and appliances for the new house. Don't go open an account with 0% interest. I have had furniture stores lie to my customers and tell them, no, this is in-house credit. We don't pull your credit with the credit bureaus. That's a lie. And
don't co-sign anything.
Do not co-sign anything, because that stuff shows up really fast. And I have had customers try kind of cheat the system and do all that new credit charge up right before closing because they think that the lender's already pulled the credit. They're not going to check again. Well, lenders got wise to that. Okay. So now lenders pull your credit again right before closing. Okay. So if they really don't need to see any new stuff, because it can absolutely shut down a closing. If they see that you have opened a furniture store account, and now you have $7,000 worth of furniture on an account, we're going to have to rework that whole loan on a new debt to income ratio because you've added a debt.
Yeah.
So we make it close, but we're not closing on that day. So it's really important. No new debt, pay everything on time. Ask your lender, I am there to help you and guide you. When we are in this 30, 45-day window where you're buying a house, check with your lender before you do anything related to your credit.
Yeah. And I think it's good practice to pull your report once a year and just look it over, make sure there's nothing out of sorts going on, and just kind of keep it clean. It's just good housekeeping and keeping an eye on your financial picture, sort of that credit aspect of it anyway.
Any of those services, and I don't really have one in particular to recommend, but any of the credit reporting services that you want to use, those might be a good idea too. I know I have customers who use them, and it tells them when somebody pulls their credit, and it asks them about any charges that are out of their usual spending pattern, because believe it or not, we all have very, very calculatable spending habits, and all those credit card companies have profiles on us, and that's how they know if something suspicious is happening. If you don't normally charge $2,500 at Best Buy, and you haven't shopped at Best Buy in 2 years, and a big charge comes up like that, a fraud alert is going to come up, and those are good things. So any of those types of services, I think, can be helpful. Yeah. So that's another way to kind of keep tabs on your credit.
What else have we not covered?
Oh gosh, I feel like we covered a lot.
Yeah, this has been a big mouthful of stuff. Yeah.
That's a lot to pack into your brain in one go round. So I guess just kind of to summarize, that credit score is a one number representation of how well you pay your debts on time. Okay, so everything in that score is related to that. The biggest parts of keeping that score good are paying every bill on time, every time, and not maxing out your credit cards. Don't charge up too much debt and get over leveraged. That is the bulk of your credit score, and that is how you're going to keep your credit up in a good high range and help you qualify for the highest price point possible for you if you don't have a lot of debt already. We want to keep the debt as low as possible.
Good advice.
Yeah.
Well, I want to thank you for coming on today. I think this is a super important topic that everyone should know about, right? At least anybody who's in the house buying. Well, actually anyone, because everyone has a cell phone, right? Everyone has insurance. That's a necessary evil in this world. It could even affect your rent. Some people don't rent to people with low credit scores, because in general, people with higher scores take better care of your property as well as their credit, right? Yeah. So it's just an important number for you.
And it'll affect your car payment. I mean, you may get if we have the same car and somebody with a 550 score is buying it versus somebody with a 750 score, that person with the 750 is going to have a lot better terms on that same car. Yeah. So it's every financial aspect of your life. And like Sherri said, even where you might be able to live, because some apartments have different credit score requirements, and a low credit score can even make certain places to live out of reach. So it really does affect every aspect of your daily life.
And it does. Well, if you have more questions about credit score and credit improvement, reach out to us. At the end of the video, we're going to put a contact card that'll have Milynda's contact information in mind. We are here to answer questions for you. We appreciate you watching today, and let us know if you have any other questions regarding any kind of veteran loan product. Milynda's our girl, and she can answer them for us.
Yeah, I would love to help.
All right. Well, thanks so much, and have a great weekend.
Bye-bye.
Thank you for tuning in. We're excited about helping ease your transition. If you're needing help or answers, please reach out. I would love to find an expert who can answer the questions in a future episode, or I can connect you with someone for more immediate help. We are here to serve you for a change. Don't be shy. My contact information is right here for you to use.